Very good morning, friends. So I hope you're all doing well. And as I keep telling, I hope you have also made revision of what we've been doing so far. So once you revise, trust me, you're going to get more confidence and try to make some add-ons in terms of the mind maps we are creating, because your effort is also equally important. So we were talking in terms of consolidation standards, the plethora of standards in which we started our inputs yesterday on Index 103. So we discussed the 7-step model, out of which we have already been on the 4th step. I gave you the step number 1 in terms of identifying the date of acquisition, typically the date when the control is acquired, which is also coincides with the date when the consideration is paid. Then the second step was identifying the accounting acquirer, because we need to see who in substance is the acquirer. It all depends upon whether a new entity is created or not, and also depends upon whether the consideration is mainly in cash or mainly in terms of shares. Then we went to the step number 3, which was divided in terms of 2 parts: the application of Index 12 when a tax rate is given, and there is a difference in terms of the carrying amount and the tax base of an asset and liability. And then making a list of net assets, which will be also including the exceptions as well. Then we went to the step number 4, one of the most crucial steps, in terms of which we made a list of 7 issues to you, and we understood the concept of deferred consideration, where you consider the present value, that's the fair value, with an unwinding later. Then we understood the concept of a contingent consideration in the capacity of the shareholder, which is again a part of PC at a fair value. And then later, depending it's classified as a financial liability or an equity instruments, the financial liability is remeasured at FPT period. If it is a contingent consideration in the capacity of the employee, it's not a part of PC. Then if the consideration is in shares, it would lead to the concept of Index 102, share-based payments at a later date. Then as far as TC is concerned, the transaction cost is not a part of the PC, immediately expensed to the P&L. Then we did the concept of a PHI, that's called previously held interest, or you can say a step acquisition. In which case, we did typically 2 cases: conversion from a passive investment to a control, and conversion from a significant influence to a control. And I think typically when you're moving from a significant influence to a control, there are 2 things which needs to be done. The fair value of the existing investment compared to the book value, that goes in the P&L. And of course, the most important, the scrutiny of the OCI in terms of deciding R&R and putting it to the P&L or RE as the case may be. Then we did the next issue, that is 6th issue, share-based payments, where we said 3 agendas: mandatory replacement, no replacement, or option replacement. And you can say in mandatory especially, we segregate the pre and the post business combination. The pre-business combination gets added to the purchase consideration. And if it is supposed to be a case of a no replacement, then it gets added to the NCI. So you need to be careful which case it gets added to the NCI and which case it gets added to the PC. Then there was a 7th agenda as well, which I did not discuss much, but I'll just quickly give you, because we want to go to the next step as well. That is on the pre-existing relationship. The pre-existing relationship will be filtered in terms of either it is non-contractual, something like a legal case between the 2 entities, or it could be contractual in nature. Now, if it is supposed to be, you can say non-contractual in nature, then it is supposed to be adjusting the purchase consideration and then making a settlement of that existing relationship. So we will make adjustments to the PC, focus 1, and we also need to settle the same, which means in terms of the step number 7, you need to put an entry in a pre-business combination settlement of that liability. But if it is arising out of a contractual relationship, we need to be careful, because not only the adjustment of PC will take place, but also the settlement, and most importantly, it could result in a case of reacquired rights. If it results in a case of reacquired rights, you need to go back to the step number 3B, add the reacquired rights as a part of the list of net assets. So typically when it comes on a contractual relationship, you need to filter that it does not trigger the concept of reacquired rights. If it does, then you need to remember to go back to the step number 3B. So that was in terms of step number 4. Now, 5 and 6 pretty easy, but we'll just try to connect a little more dots, connecting a concept of impairment as well. So let's, I think, go to the next one. So my mind map for the day. So this is the mind map number 1, or I would say it's a part of the sub steps only. So this is a mind map for the step number 5. So we're covering the mind map for the step number 5, which is the calculation of the NCI. Now, I think here you just need to keep a few filters in mind. NCI could be calculated on the basis of either PASNA or on the basis of fair value. The instructions will be clearly stated in the question. That's not an issue. But I think the most important part is connecting the calculations of NCI to the concept of impairment. So I think in this mind map, I will also like to enter that, though the concept of impairment will be faced when you come to Index 110, when you do the consolidation, because impairment is not on the acquisition date, but is going to be done later. But I think I will still pen the thoughts out here. So when you look at the NCI, there is a choice which is given in the standard. Either it is taken at PASNA, that is supposed to be proportionate share in net assets, or it can be taken at a fair value. So whatever the case might be, that instructions will be clearly stated in the question. So no worries, will be stated very clearly that this is a case of PASNA or a case of a fair value. Now, once you consider the NCI and a PASNA, your mind should tell you that in this particular case, what we need to consider? We will consider the net assets which is there in step number 3B. And we will multiply this with the percentage which is held by NCI. As simple and straight. And if it is supposed to be at a fair value, then in this particular case, we need to consider the number of shares. We need to consider the number of shares held by NCI, and this is got to be multiplied with the fair value per share. That's the fair value per share of the acquiring company, of course. That I think goes without saying, but I think just put that once again. Now, as I said, not too technical, but I think at this stage, though not relevant from the point of view of 103, but I think you need to connect the dots in terms of 110 as well. So, if you were to consider the NCI at a PASNA, we get what is called a partial goodwill. We get what is called a partial goodwill once we go to the step number 6. This partial goodwill means once an impairment of the goodwill takes place, that is borne only by the parent, not by the NCI. So the implications of partial goodwill is that once there is an impairment, so this is going to be borne by parent company only. So putting it as P company. So this will be borne by the parent company only. But if you say that the NCI is taken at a fair value, in this particular case, the NCI, the goodwill is what is called a full goodwill. And in this particular case, later when we see that there is any impairment, this impairment is supposed to be borne by, both the parent company as well as the NCI. So the impairment is going to be split between the parent and the NCI. So I think this is one connect which should be very clear in your minds. Then when you say it is PASNA, it means partial. And I always tell people that for easy remembrance, the things are good. Pasna stands with P and partial stands with P. So it's like PP. And similarly, when you consider a fair value, it starts with F and the full goodwill starts with F. So it's like FF. So anytime you're in trouble to think, oh my God, what was it? Then you can easily connect some dots. This is the P and this is the P. So it's like partial and it is Pasna. And this is like F and this is like F. So this is like FF. So that will help you to just recall the concept quickly that we are considering Pasna partial borne by parent PPP. And if it is supposed to be fair value, then it is fair value, then it is full, and then it is borne by the parent NCI both. Now that is not FFF. But just for easy recall, that's the connect I've given you. Okay, so we're not doing any question in terms of NCI. I think this is fairly simple and straight indeed. Let's go to the next mind map, that is in terms of goodwill computation. So we make a mind map for the step number 6. So our next mind map, which is for the step number 6, that is the goodwill calculations. It can be goodwill or it can be what is called a bargain purchase gain. That is typically, you can say, capital reserve. So you call it as a bargain purchase gain or you call it as a capital reserve, one of the same thing. Now, we know that when you calculate the goodwill, it is computed in a certain sequence. You need to consider the sum total or the purchase consideration, to which you will add the NCI on the date of acquisition and then compare it with the net assets which you computed in step number 3B. Of course, at this stage, when you're looking at the acquisition date, impairment is not on my mind because impairment will take place only at the balance sheet date. But you just need to filter that in this case, we will take the purchase consideration, which you have already computed in step number 4. And this we add the NCI on date of acquisition, which you have calculated in terms of step number 5. Once you take the sum total of these, it makes it like 100%. The PC plus the NCI makes it indirectly 100%. And then you compare this with the net assets, that is on the date of acquisition, which you have computed in terms of step number 3B. So this is just, putting the data across, just connecting the information, whatever you filtered in the previous steps, and you get the goodwill. So let's, on a very simplified version, if you take this as X and if you take this as Y, if the X is greater than Y, the difference is goodwill, and if the X is less than Y, the difference is a bargain purchase gain. Goodwill, of course, will be on the asset side. Bargain purchase gain will be added in terms of other equity in the consolidated balance sheet. Then after these 6 steps are done, you just need to filter the data, put it in the acquisition entry, which was our step number 7. I think that takes care of the insights in terms of each and every steps. I think we're ready in terms of doing a larger question with you. So I think I want to do, first of all, a question on acquisition accounting. Then I want to do a larger question on a reverse acquisition. And then we will do a question on a common control transactions before we close India's 103. So let me, I think, first share a question to you. I am going to first take a question which is on acquisition accounting. It's one of the questions in the study material as well. I think this is similar kind of questions came in the exam. It is the question number 7. And this is MTP April 2019. It's in the study material as well. Let's, I think, first read the inputs. Now, when you read a question, I think you need to be careful, as you're reading, your mind should also start connecting that which information is going to be related to which particular step as well. Now, we're given the balance sheet of professional as well as dynamic. It says on 31st March X2. Now, there is nothing much to see in the balance sheet so far. So we go on to the additional information. It says Professional acquired 70% shares of Dynamic on 1st April X2 by issuing its own shares in the ratio of 1 for every 2 shares of Dynamic. So we're given the swap ratio, it's 1:2. And the fair value of the shares is 40 per share. That means this is a point relating to the purchase consideration, step number 4. Then he says the fair value exercise resulted in the following. So we given the fair value of a PPE, and it also says that Professional Limited agreed to pay an additional payment as a consideration that is higher of 35 lakhs and 25% of any excess profits in the first year after acquisition over its profits in the preceding 12 months. This additional amount will be due in 2 years' time. Dynamic has earned 10 lakhs in the preceding year and is expected to earn another 20 lakh. Now, this needs a very careful interpretation. On a very apparent front, when you read that it is the higher of the two, it gives you a sense that this is supposed to be a contingent consideration. Because when it says you're going to make a payment which is higher of 35 lakhs or 25% of the excess profits, but we need to understand one thing, that when we say that it is the higher of the two, which means a minimum payment of 35 lakhs is bound to be given. Imagine if 25% of the excess profit is 20 lakhs. So you need to pay 35 or 20 lakhs, whichever is greater. So you'll end up paying 35 lakhs. And let's imagine if 25% of that excess works out at 45 lakhs. Then you're going to pay 45 lakhs, which means you are in any case going to pay 35 lakhs for sure. Because when the payment is greater of the two, not lower of the two, this is quite indicative that a minimum payment of 35 lakhs will be paid, which means the payment of 35 lakhs is a deferred consideration, which is going to be paid irrespective. And the payment of that excess, that is going to be contingent because it depends upon the excess earnings. Now, in this particular case, we are nowhere given the fair value of the contingent consideration. So in the absence, I will not be able to capture the fair value of the contingent consideration as a part of the PC. So what we're going to do, we're just going to consider the 35 lakhs, which is supposed to be a deferred consideration, that will be included at a present value, which is the fair value. It's going to be paid 2 years later. This point is again relating to the step number 4, except that the fair value of the PPE is relating to the point step number 3B. And the presence of the fair value immediately should trigger your thoughts that there could be a deferred tax implications, provided a tax rate is good. As I'm reading the connect questions, I'm trying to connect the dots. Then it says further in point number C, it says, in addition to the above, Professional Limited also agreed to pay one of the founder shareholder a payment of 20 lakhs provided he stays with the company for 2 years after acquisition. Now, this payment is again a payment to be made at a future date. But in this case, again, it is contingent, but we need to filter whether it is in the capacity of employee or in the capacity of the shareholder. Now, since the conditions attached is that he needs to stay in the company for the next 2 years, there is a service condition. And if you remember, we decided when there is a service condition, it becomes in the nature of employee, not a part of PC. So this point is also related to the step number 4, that is purchase consideration. Then it adds on further in terms of point number D, it says Dynamic. It says Dynamic has certain equity settled share-based payments, that is called the original award, which got replaced. The language is very clear, which got replaced. Now, when I say which got replaced, it indicates a mandatory replacement. And it says, as per the original terms, the vesting period is 4 years. And on the acquisition date, the employees have already served 2 years of service. That's the vesting period completed. Now, as per the replace awards, the vesting period is reduced to 1 year. That means instead of the remaining 2 years, now it stands at 1 year. The fair value of the awards on the acquisition date for the original and the replacement awards are given. That again relates to the step number 4, that is the calculation of PC. I think the question is testing us heavily in terms of the calculation of the purchase consideration. Then he says Dynamic has got a lawsuit pending with a customer who made a claim of 50 lakhs. Management estimated the fair value of this liability. Now, a lawsuit pending against the company is something which is a contingent liability. And in terms of Ind AS 103, if there is a contingent liability in the books of the equerry and you can reliably estimate a fair value, that becomes a part of the step number 3B list. That relates to the step number 3B. And this will also lead to deferred tax consequences if a tax rate is given and the point number F gives you a tax rate. Now, you are required to prepare an opening consolidated balance sheet of professional on April X2. So the focus is not on the acquisition entry. That's going to be a part of the working note. The focus is directly making a consolidated balance sheet. And then he also adds on a 10% discount rate as well. Now, one thing which I would like to remind you, which I think I might have said earlier, but I think to reiterate is based on the requirement of the question. I always tell people that Ind AS 103 is like a bridge between the separate financials of the parent and the consolidated financials of the parent. If to the separate financials of the parent, you add the acquisition entry as per 103, the resultant product is supposed to be the consolidated balance sheet as on the date of acquisition. Now, in this case, we need to go for all the 7 steps and then incorporate the 7th step entry in the standalone financials to give you a consolidated balance sheet. So I think let's begin the journey. So I am going to first of all start with my initial steps. Let me just open the question also in front of me. So as I said, this is one of the questions which is there in the study material as well. So I think let's begin the journey. So the question number which I gave you in the handout, that is question number 7. So this is a comprehensive question involving the application of all the steps. So once we do this question, you need to make a walkthrough in terms of each and every step. Your mind should be focused when you do a particular step that, okay, this is what we need to do in each and every step. So let's begin the input in terms of the step number 1. Now, many people say that is it good to write down the steps or can I use the working notes? Well, I think it's fine. You can even say working note number 1. Get on to the 7 working notes instead of steps. That's only to make life simple. So I think you can use steps, working notes, whatever you feel comfortable. So in terms of the step number 1, we need to identify the date of acquisition. And I think that's not an issue because this is very clearly given in the question. It very clearly says in the point number A of the question that it was acquired on 1st April X2. That is the date of acquisition. Then we go on to the step number 2, and we need to get who is the accounting acquirer. So we need to filter and get who is the accounting acquirer. Now, I want to go a little more systematic based on our discussions. How do you get the accounting acquirer? Now, there are 2 inputs what we need to keep in mind. Was a new entity created? No. And the shares are the primary consideration portion. So I think it's good sense to calculate a pre and a post business combination percentage to actually decide the status. So we can make a mention to the examiner that new company is not created. Because if a new company is created and the consideration is in primarily in share, we know it becomes a case of reverse acquisition. But once a new company is not created and the consideration is in shares, then we need to see pre-post business combination. So we'll filter and look at the pre-business combination position and the post-business combination position. So let's see the number of shares which the parent company, or we can say the acquirer, had in the company. Now, if you look at the balance sheet of professional, he has got shares which are supposed to be a total of 10 rupees each. Though I think it's slight misprint, it's not 100 for both. For professional, the face value is 10, and for dynamic, the face value is 100. So if you look at the face value of professional, it's 10 rupees each. So he has got a total of 50 shares. 50 in the sense, the balance sheet which is given to me is all in terms of lakhs. So they've got a total of 50 lakh shares. So we can say the shareholders of Professional Limited were in full control of the company because all these 50 lakh shares were with the shareholders of Professional. Now, later, post-business combination, some shares were issued to the shareholders of the acquiree, and it says in point number A that we will issue 1 share for every, it says 2 share. Now, Dynamic has got a share capital of 400, the face value is 100. Professional is 10 and Dynamic is 100. So Dynamic has got 4 lakh shares, and we told him that we will give you 1 share for every 2 shares. So we will give you 1 share for every 2 shares. So the total number of shares which will be, but before this, we also need to consider we did not acquire all the shares. So I think the important part of the calculation is we also need to consider that we acquired what percentage. So Professional acquired 70% shares. So we're trying to calculate the total number of shares in Professional. 50 lakh shares were there in the company. 4 lakh shares, out of which 70% acquired in Dynamic. We issued 1 share for every 2 shares. So this works out at 4 into 70%, 1 by 2. The total number of shares of the company is 51.4. So I think if I just try to calculate the percentage, so we can say now we have got 50 lakh shares out of a total of 51.4 lakh shares. So if I look at the percentage, post the business combination, it comes to around 97% approximately. Percentage dilution has taken place, but Professional did not lose a control over his company. So I would advise whenever the purchase consideration is in shares and no new company is created, a comparative in terms of pre and post business combination is a good exercise. So this indicates that the legal as well as the accounting acquirer is the same, because the company did not lose a control over its own company. The legal and the accounting acquirer is same. So in this case, Professional Limited, let's call it as P Limited, he is supposed to be the accounting acquirer. So down the step number 2 a little more, comprehensive manner, so that we understand the nitty-gritties and we tell the examiner, yes, I do understand the clarity. This is step number 2. Then we move on to the next step, and that is step number 3. And since we are given a tax rate, so we need to apply the applications of Ind AS 12. Since the tax rate is given, before we make a list of the net assets in this case, we need to filter all those assets and liability whose fair value as well as the tax base is different. You need to create a deferred tax implication. So what we're going to do, we're going to make a simple little chart. So we just make a simple little chart, take the name of the item, that is the asset liability, get number 1, the carrying amount, which is fair value, get the tax base, get the difference, and convert this into a DTA, DTL as the case may be. So let's take the item, that is the asset liability, and let's consider the carrying amount, which is equal to the fair value. Let's calculate a tax base. Let's get the temporary difference, segregate this in terms of taxable or deductible, and then we get a deferred tax, segregate this in terms of DTL if it is taxable and DTA if it is deductible. I don't use short forms in the exam. I am just using it for convenience. So you could write down it is temporary difference, taxable deductible, deferred tax, DTA, DTL. That's, I think, still fine. Now, let's go back to the inputs and see which items the fair values are defined. So I am given, first of all, the property, plant, equipment. So we are given The first item, that is property, plant, equipment, the fair value is given, it's 350 lakhs. Now, as far as the tax base is concerned, it has to be what is stated in the balance sheet. Because in any case, the tax people will not give you a deduction equal to the fair value. They will give you a deduction equal to the original cost less the depreciations already given. So PPE in the balance sheet of Dynamic is supposed to be 500. Now, in this case, the tax base is greater. So when the tax base is greater for the asset, it becomes difference which is deductible temporary difference. So I'm putting it as DTD. And this will lead to a deferred tax asset in this case. Now, we're also given a tax rate in the question at the end. The tax rate, it says, is at the rate of 30%. So if you consider a 30%, that works out at 45. That is DTA. So let's go further. The next item we know is the contingent liability. And we are given in the additional information in terms of point number. The contingent liability is given in terms of the point number E. It says the fair value of the liability is supposed to be 5 lakhs. But as far as a tax base is concerned, well, we are not going to be given any deduction. So this is 0. So this is also greater. But in terms of liability, when the carrying amount is more, it results in a deferred tax asset. So this is again deductible temporary difference. 5 into 30%, 1.5. That also becomes a DTA. So all those assets and liability whose fair value, which is the carrying amount, is different as compared to tax base, will get filtered in this list. Now let's take the sum total of this. So we get the total deferred tax asset, that is 46.5. This is a DTA. Okay, so now based on this information, we're ready to go to the next step, number 3B. Once this is done, the list of the net assets needs to be filtered. So let's go to the step number 3B. Trust me, if you're doing the question coolly and your focus is very clear in terms of what is to be done in each step, it's not a very difficult job because you are very clear in terms of thoughts that this is what is to be focused at each and every step. So now we need to make a list of net assets. And we need to remember to consider this deferred tax as a part of this list as well. So we'll start a journey from the balance sheet of the ICAI. Start looking at the assets side of the balance sheet. Start picking the items. If you're given a fair value, take that. If not, take the book value. So let's begin with the balance sheet on the asset side, PPE. So we are given a fair value. So PPE, we consider a fair value, that's 350. And I think least I forget, let's take the DTA, which you've already taken in terms of step number 3A. So let's filter that and take it immediately. Then next we are given there is an investment, that is 100. I am not given any fair value, so this is 100. So these are the non-current assets. Then we've got inventories. And inventories are to the extent of 150. Then there is a trade receivable, that's 300. And then there is a cash and cash equivalents, that is 100. And then there is others, that is 230. So I think that takes care of all the assets. And then we are given in the liabilities, there is a long-term borrowings. And there is a long-term provisions. So long-term borrowings is 200 and the long-term provisions is 70. And then we are given a DTL in the balance sheet, that's 35. So that would also be a part of the list. And then we are given the short-term borrowings and trades payable. The short-term borrowings is 150 and the trades payable is 300. And least we forget the contingent liability, which was fair value 5. So I think all the items stands done. We can maybe, have a quick look at the items in the additional information, but I don't think so there is anything else. So 350 plus 46.5, 100, 150, 300, 100, and 230 minus all the liabilities. I think this works out at 516.5. So this comes to 516.5. This is the list of the net asset. Right, so not a complicated part. Now comes the crucial step, which is the calculation of PC, and I think this question mainly focuses in terms of step number 4. If you look at the questions which are given in the RTPs and exams, you will focus if you are proficient, if you are clear in terms of step number 3B, as well as step number 4, there's no much complications in other step, because getting the acquisition date is a very apparent exercise, and then deciding the accounting acquirer is not a big deal. If you are able to get expertise in step number 3B, list of net assets, typically those exceptions, and you're able to get your expertise on the calculation of PC, goodwill and say again is a very simple computations itself. So I think that's the core area where I think if you focus, Index 103 is like more in your grips. Okay, now let's go to the next step. That is step number 4. The step number 4 is the calculation of the purchase consideration. It is the calculation of the PC, that is the purchase consideration. Now, I always advise people that it is always better to first make a format, because we know there are 7 issues and it's not a bad exercise that you first make a list of all the 7 issues which are there pertaining to PC, whatever is relevant, take it. Yes, as you practice more, of course, you can just concentrate on what is relevant to the question. But since we are practicing right now, I'm going to write down all the 7 issues, take whatever is relevant in this case. So the first is when you calculate a purchase consideration, we are given the shares issued. So we are given the shares issued and we need to take them at a fair value. So we are given that as a part of the purchase considerations, we are issuing shares. So we need to take the fair value of those shares. So if you go back to the point number A, professional is acquired 70% shares, issued 1 share for every 2 shares, and the shares of professional is 40 per share. So we done that calculations in step 2 as well. So as far as Dynamic is concerned, he's got 4 lakh shares. We acquired 70% shares. We issued 1 share for every 2 share, and the fair value of the share is 40. So 2.8 lakh shares, 1 share issued for 2 at the rate of 40, that works out at 56. This is all in lakhs. This indirectly becomes like a base, that when you're calculating a purchase consideration, this indirectly becomes a base, that this is the cash and the fair value of the shares which is issued. Now let's take the list of those 7 issues with us. So I think I'm just penning down the inputs. We've got a deferred consideration. We've got a contingent consideration in the shareholders' capacity, a contingent consideration in the employee capacity. Then we've got a transaction cost. Then there is a PHI. Then there is a share-based payment. And then there is a pre-existing relationship. So once all these focus points are there in front of you, then I think it's a little easy exercise in terms of calculating the purchase consideration. So let's now filter one by one the information which is given in the additional information. So I am given, first of all, in terms of point number B2. And if you remember, we had a discussion that the payment is 35 lakhs or 25% of the excess profits. But we were not given any fair value of the excess profits. So we're just looking at the deferred consideration. So 35 lakhs is the amount to be paid. and this is to be paid 2 years later, for which the discount rate is given to me at the end. It's at the rate of 10%. That's given at the end. Since this payment is going to be given, it says over its profits. So this addition is due after 2 years. So discount this at 10% for a period of 2 years. We need to consider the present value of this amount. So that comes to almost like 28.93. 28.93 lakhs rounded off. Next, we are given in terms of point number C, professional agreed to pay to the founders provided they stay with the company. Now that is employee capacity not to be taken. So just to make a mention, this is the point number C. This is the point number C in the question. So we are not given any payment, which is shareholders capacity. Okay, let me first see. So point number C is done. Yes, there is nothing which is there in the shareholders capacity. Then we are given in point number D regarding a share-based payment. Now we are very clearly given the fair value of the original award on the date of acquisition. When you consider SBP as a part of the PC, you need to consider the fair value of the original award on the date of acquisition. And we need to consider a proportion, the vesting period completed upon the total or the original vesting period, whichever is greater. Now, the original vesting period in this case is 4 years. 2 years have already elapsed and the acquirer decided to keep another 1 year. So we can say the original vesting period is 4 and the total vesting period is 2 plus 1, 3, whichever is greater. So we take 2 by 4. This comes to 2.5. Then I guess we are not given any informations on TC, PHI or pre-existing. Of course, in the exams, when you're doing this particular question, you may avoid writing all the 7 issues. You can take only what is relevant. But since I was just trying to practice, I thought, let's make a list and so that we are concentrated that, okay, this is relevant and this is not. So let's take the sum total of the purchase consideration. So this is 56, 28.93, and that's 2.5. I think this comes to 87.43. This comes to 87.43. Well, so I think my purchase consideration is done. The step number 4 also stands done. Now, step number 5, and which is the calculation of the NCI. So we go to the step number 5, which is the computation of the NCI. And as far as NCI is concerned, I don't think so. Anywhere we are given in the question that we are considering a fair value. So in the absence, unless mentioned otherwise, it's going to be simply PASNA. So you can make a reference to the examiner as well that this is being taken at PASNA. So we take the net assets into the percentage which is held by NCI. So you've already made a list of net assets. That was 516.5. So we take 516.5. 30% is with the NCI because 70% shares belongs to the parent. So we can take 30% of this. That's 154.95. And then we can go to the step number 6, and that is the calculation of goodwill or the bargain purchase gain, as the case may be. So you can see it's very systematic, very smooth indeed. If you're focused in terms of what is to be done, it's not at all a tough job. So let's take the sum total of the purchase consideration, and this we add the NCI, and then we compare this with the net assets. So we'll get the difference, goodwill or the bargain purchase gain. My PC is 87.43. My NCI is 154.95. And my net assets is 516.5. So this is 87.43, 154.95 minus 516.5. This is 274.12. Now this is a capital reserve because your net assets is greater as compared to the sum total of the PC as well as the NCI. That's it. But we're not done with the question. We yet to make a balance sheet as well. But I think it's a good exercise to complete the step 7 as well. Give the acquisition entry. Then I think I'll give you the trick in terms of making the consolidated balance sheet on acquisition date. So let's also consider step number 7. That is the acquisition entry. And this acquisition entry is on date of acquisition, and that is in the books of accounting acquirer. That is the books of professional limited. Just to connect the dots in this case. Now we're going to put the entry in this case, and everything is very clearly available in the steps which we have computed. So let's consider the net assets. So we consider the net assets. Now, I'm not putting each and every asset in the entry. I think, of course, you can do that in the exams, but I'm just taking the consolidated figure. That's 516.5. And we take the purchase consideration and we take the NCI as a credit. The PC is 87.43. The NCI is 154.95. And we're getting a capital reserve, which is 274.12. If you actually notice, it is nothing but a copy of this as it is in the form of this entry. Because at the end of the day, when you're taking the purchase consideration, you're taking the NCI, it's like the credit side of the entry. When you're taking the net assets, it's like the debit side of the entry, and the balancing figure is a capital reserve. So it is nothing but some complete copy of the goodwill calculations itself. Okay, so I think this takes care of all the 7 steps with me. Now we will see how you can easily make a balance sheet. Because many times students make balance sheet and they tend to go wrong. Though it's a very simple exercise because you've got a balance sheet of profession in the question, you made an acquisition entry. So it's all about, just adding line to line. So the best way to do it. So we'll make a consolidated balance sheet of the date of acquisition. So I think the best way to do this is something like this. The best way to do it is something like this. You take the balance sheet from the question, take the adjustments, and get the consolidated balance sheet. So I think that's how you're going to keep a track. So this is let's take this as asset side only. This is assets. We are making a consolidated balance sheet on the date of acquisition. So this is, I would say, the separate financial statements of Professional Limited. And this is the Index 103 adjustment entry. And this is what we will get, the consolidated balance sheet of Professional Limited. So that's an easy way that you will keep a track in terms of what things are going. You cannot go wrong in this case. Now let's begin with the asset side of the balance sheet. And we just keep inserting the acquisition entry. The tendency at many times of the student is, let me add the balance sheet of the parent and the subsidiary, because you get used to the fact that consolidation is an aggregation of assets and liability. But I would advise, don't look at the balance sheet of the subsidiary. Now, even if you want to look at the balance sheet, it's fine, but you need to keep a track that there are some fair values in the acquisition entry. So let's begin with the non-current asset side, that is PPE. So we take professional is 300, and from the acquisition entry, fair value. From the acquisition entry, we take the fair value. So this is 650. Next, we are given the investment. I think let me first take goodwill. And goodwill we took, no, there was no goodwill, there was a capital reserve. So if it was goodwill, we would have taken out here. Then next we consider investments, and that's I think 400, 100 in the acquisition entry, that makes it 500. Then next we are given the current assets, and we've given inventories, trade receivables, cash and cash equivalents, and we've got others. So inventories, it's 250 as well as 150, that makes it 400. Then trade receivable is supposed to be 450 and 300. I'm not taking these figures from the balance sheet of the subsidiary. I'm picking from the acquisition entry, by the way, though we can comfortably see the balance sheet and just change it to a fair value. Cash equivalents is 200 and 100. So that makes it 300. And others is 400 and 230. So that makes it a total of 630. I guess that's it on the assets side of the balance sheet. So making a balance sheet is also not a big deal. If you just focus on the entry, it's going to be simple for 650, 500, 400. This is coming to 3230. That is the asset side of the balance sheet. Let's continue with the liability side as well. Same formatting for the liability side. This is liability. Take the figures from the P's balance sheet, 103 entry, and the total. So this is going to be the separate financial statements of professional. This is the acquisition entry in this 103. That is the consolidated financial statements of the parent. And this is my equity and liability section. Okay, so let's pick up the information in terms of equity. And this is one area where sometimes we tend to go wrong. So we need to consider that as far as NCI is concerned, it's a part of the equity section in the consolidated balance sheet. So remember to take the NCI as well. So if I go back to the balance sheet, so we've got share capital, and then we've got other equity, and I think least we forget we take the NCI. So share capital will be only for the parent. That is 500. Nothing was there in the acquisition entry. So other equity is 810, but we took a capital reserve. So I think that is a part out here. That was, I think, 274.12. Because this is going to be a part of the other equity itself. Now, there is something, which also needs attention at this particular stage. As I make the liability side, there is another important input which I did not take care at that stage. Now, let's go back to the 7th step and get some more insight. This purchase consideration has got a couple of items. We've issued shares, which has got a face value and which has got a premium. And then there is also a deferred consideration, and there is also a share-based payment. So it's a good idea that this purchase consideration discharge entry should be done separately. Because when you go to focus on the liability side of the balance sheet, you'll need the bifurcation of that 87.43. So what I'm going to do, I'm just going to add another entry for the discharge. For the discharge of the purchase consideration. So here we are able to filter exactly the breakup of the PC equity share capital premium, because premium will go to the other equity, face value will enter the equity share capital, and so on. So if you look at the discharge of the PC, the purchase consideration gets a debit. That is, I think, 87.43. The first thing is we issued shares as a part of the purchase consideration. I'd like to just remind the calculations once again. In this particular case, 4 lakh shares were acquired, 70% shares were acquired. We issued 1 share for every 2 shares. So when you multiply this with 10, that's the face value. And when you multiply this with the remaining 30, that is the premium. So number of shares into 10 is the face value, number of shares into 30, because the issue price was 40. So 10 being the face value, 30 is the premium. So this is going to be 1.4 into 10, that's 14. And this is going to be a total of 42. That's 1.4 into 30. Okay, and then there was a deferred consideration. I think that was 28.93. And then we also gave share-based payments as a part of PC. Now, since it is an equity settled payment, that amount is going to become SBP reserve based on the concepts of 102. So we're going to take this as SBP reserve. So the payment which is for the share-based payments, I think it was 2.5. Let me just, I think, check the sum total. Yes, it matches. Now we need to remember to take this as a part of the equity section. So this will enter the equity section. This will enter the equity section. This will be share capital. This will be other equity. And this will be other equity. And this deferred consideration is a non-current liability because this is going to be paid 2 years later. So I think now it's time to go back to the balance sheet on the liability side to filter and incorporate these changes. So we need to make change to the share capital. So in the share capital, we will consider the face value 14. That comes to 514. Now we've taken the capital reserve, but we also need to take the share premium. So let me create some space. The share premium was, I think, 42. Then I also need to take care of SBP reserve. And that was, I guess, 2.5. So I think we've taken care of share premium, we're taking care of the share capital, we're taking care of the SBB reserve, and the capital reserve. DC will be taken later. So it's a good idea also that instead of filtering all this information here, you could make a separate working note, a statement of changes in equity, because this is all a part of the other equity. It's part of the SOKI, so that can also be done. So 810, 274.12, 42, and 2.5. This is, I think, coming to 1128.62. And then we consider the NCI. That was, I think, 154.95. That is the NCI. Right, I think the equity section is done. Now let's come to the liability section. So back to the balance sheet of the company. So on the non-current liabilities, we're given long-term borrowings. And I think that DTA can be set off against a DTL because we have a DTL in the balance sheet and we've got a DTA in the acquisition entry that can be netted off. But you can just give a note that they have been set off. The breakup has to be given in the notes. So long-term borrowings is 250. And in the acquisition entry 200, that makes it 450. Then there is a long-term provisions, and that is 50 and 70. That makes it 120. And I guess we can consider deferred consideration and we can consider DTL. So deferred consideration was, I think, 28.93 in the adjustment entry. So this is in the step number 7. Now, as far as DTL is concerned, it is 40 as well as 35, and DTA, I think, was 46.5. DTA was supposed to be 46.5. So that will get netted off. So this is going to be 40 plus 35 minus 46.5. This is 28.5. We've got more liabilities to go. Okay, so this is done. Then we given short-term borrowings and trades payable. I am just taking the figures above short-term borrowings and trades payable just to keep everything on one place. Short-term borrowings is 100 and 150. That makes it 250. And trades payable is 250 and 300. And that makes it a total of 550. I guess hopefully the balance sheet should get tallied. So it's coming to 3 to 5. There is a contingent liability of 5 as well. So I think we can add that contingent liability as well. So that was 5. That is 5. So we get the total of the balance sheet. That is 3230. That tallies with the asset side of the balance sheet. Wow. So I think it took us almost around, I guess, what time? Maybe around 45, 50 minutes to do the question. But I think this is a little decent time because if this question comes, I think it comes easily, for a good number of marks. So I think that much time spent is fine. Great. So this was a question pertaining to the concept of acquisition accounting. Now, we are going to do now a question based on a reverse acquisition. The steps remains the same, except that we don't need to do the step number 7 in terms of reverse acquisition. But I think the most crucial part in terms of reverse acquisition is the calculation of the purchase consideration. Everything is exactly same, but I think PC is the only important input to be watched out. So let's, I think, do another question with you on reverse acquisition. Let me share the question to you. So I'm going a little back. This is question number 5 on the handout. So let's have a look at the question number 5. So the question is, very clearly giving us the insight that this is a case of reverse acquisition, but I'll still compute it in a way that I am trying to identify the same. It says on 30th September X1, entity A issued 2.5 shares in exchange for each ordinary share of B. It says entity B shareholders exchange the shares in entity B. Therefore, entity A issues 150 shares in exchange for 60 shares of B. So if you multiply 60 into 2.5, that works out at 150 shares. So A gave 2.5 shares for every 1 share of B, 60 into 2.5. The fair value of each ordinary share of B is 40, and the quoted market price of A's ordinary share is 16. And I would like to show you something interesting at this stage. If you consider the fair value of 40 and divide it with the fair value of 16, 40 divided by 16, that works out to the extent. It says that is 2.5. So which means in this particular case, the ratio of exchange is supposed to be based on the market price of the shares. And then it says the fair value of entities A, assets and liabilities are given, and they are the same as their carrying amount, except that the fair value of entities A, non-current assets, is 1500. Now, here is the important catch. If you notice, every input in the first para is considering that A acquired, A issued shares, but suddenly the tone changes and he gives you the fair value of the assets, net assets of A. This is also indirectly a subtle hint telling you that this is a reverse acquisition. Because when you prepare the list of the net assets, the list of the net assets is prepared for the accounting acquiring. And when he gives you the fair value of net assets of A, it's like an indirect hint. And then it says the statements of financial position of A and B immediately before the business combination is given. And in the balance sheet, it is very clearly indicating that it's a reverse acquisition because A is the legal parent, but is the accounting acquiree. And B is the legal subsidiary, but he is the accounting acquirer. Then he adds on that assume that entities B earning for the year is 600 and the consolidated earnings are 800. Assume that there is no change in the number of ordinary shares issued by B for the year ended December X0, and during the period January to 30th September, that is up to the date of reverse acquisition. So everywhere very clearly stated, it's a case of reverse acquisition, but I'm still going to prove it that it is a case of reverse acquisition. And trust me, that proof is also a necessary requirement. Because in any case, unless I prove that it's a reverse acquisition, all those calculations which will go in proving it to be a reverse acquisition is necessary. Now it says calculate the fair value of the consideration transferred, measure the goodwill, and prepare a consolidated balance sheet on 30th September X1. And he's also asking you to calculate the EPS. Now, since I picked this all from the education material, the focus was in a blend of Indus 33 as well as 103. But I think I'm going to concentrate only on the 103 aspect, that is on the reverse acquisition. So this is also given in the study material as well, and it's in the education material issued by the institute as well. Okay, so let's, I think, go to the question number 7 answer. Yes, that was question number 5, sorry. So this is the question number 5. We'll again begin a journey in terms of each and every step. I would say even if the question is very clearly telling you that it is a reverse acquisition, but still you need to identify it's a reverse acquisition, because all that information, all that data which will go in identifying the case that it is reverse acquisition will become a very necessary calculations of your purchase consideration. So I would say you should still identify it being a reverse acquisition. Okay, so let me just open the question and let's begin the inputs. So let's, I think, start with the inputs on the step number 1. So in terms of the step number 1, we need to get the date of acquisition. And I think that is very clearly stated in the question. So that's not an issue. So we very clearly stated in the question the date of acquisition. It says at the very beginning, 30th September X1. So we are given the date of acquisition. That is supposed to be 30th September X1. Then we go on to the step number 2. And in terms of step number 2, we get the accounting acquirer. We already know this, who is the accounting acquirer, but still we'll go through the entire process of identifying the accounting acquirer. And I'm again pinpointing this is something which you should do, because this information, what we are calculating, will be required for the PC as well. Okay, so let's do one thing. Since no new company is created, we'll again make a little input to the examiner. No new company was created. So we'll just make the inputs that no new company was created in this case. So what we're going to do in this case, get the pre and the post business combination movements. So let's see the comparative. So we're going to see the pre-business combination and the post-business combination. Now, if I look at the shares of B, entity B has got a total of 60 shares and A has got 100 shares. So if you look at A, he's got 100 shares in the company. And now the share capital will increase because you're going to issue 2.5 shares for every 1 share. So the total capital base of the entity A will increase to 250 shares. So if I look at the percentage which A shareholders will get in the company, so they've got 100 shares out of the total shares of 250. So we can say this works out at 40%. And that's a very clear-cut case that the control has got diluted. A, by issuing shares to the shareholders of B, lost a control in favor of shareholders of B. That means B is the accounting acquirer. So this gives a conclusion that B is accounting acquirer. because A has issued shares in such a way that he lost a control of the company. Right. So I think that proves it, though it is clearly stated in the question, but still we've proven the fact. Now let's go to the step number 3. So now we come to the step number 3, and I don't see any tax rates which are given in the question. Since no tax rate is given in the question, the calculations of deferred tax is not required. So we can directly make a list of net assets without making a mention about the deferred tax implications. So we'll make a list of net assets. Now, one thing which we need to be careful on, that when you make a list of the net assets, we need the list of net assets of A. Why A? Because he is the accounting acquiring. So that is one crucial point which you need to take care when you draft a balance sheet of when you're going to make the inputs, because we need a list of net assets of the accounting acquiring. Here the legal parent is the accounting acquiring, A. So let's begin with the balance sheet and pick the information. So we start with the current assets. I guess the fair value is given only for a non-current assets. So this remains 500. Then there is non-current assets. And I guess the non-current assets of A is to the extent of 1500. Rest, I don't think so we given any fair values. And then there are two liabilities, current and non-current. So current liabilities and non-current liabilities, that's it. So current liabilities is 300 and non-current liabilities is 400. So let's get the net position. This is 1300 is the net assets. Right, so I think the step number 3 was simple and straight and cute indeed. Now let's go to the step number 4, which is a very, very crucial step. Now, before we start with the step number 4, that is the calculation of the purchase consideration, let me, I think, draw your attentions to the crucial point. Since the reverse acquisition is crucial in terms of PC, you need to be clear on one thing, that when you calculate a purchase consideration, the idea is not to see what is paid, but the idea is to see that what should have been paid. So in terms of acquisition accounting, when you calculate the purchase consideration, in terms of acquisition accounting, when you calculate the purchase consideration, the focus is what is paid. The focus is what is paid. That is one thing. And now you need to consider that when it is a case of a reverse acquisition, once it is a case of reverse acquisition, the focus changes from the fact that what is paid to what should have been paid. Because now we will consider that if B would have paid a consideration to maintain the same stake which he's getting today, I need that. So the focus is what should have been paid. What should have been paid. I think this is one focus. If you keep in mind, it'll be easier to make calculations as well. So I think this is one pertinent thing which you should keep in mind, that in acquisition accounting, the PC is what is discharged. But in terms of reverse acquisition, the focus is not what is paid, but what should have been paid by B, because actually the consideration is paid by A to B. But we need to consider what if B would have paid the shareholders of A. So I think with this focus points, let's go to the step number 4. So in terms of the step number 4, to calculate a purchase consideration, now we need to consider what B would have paid to maintain the same percentage, as he is getting now. So we need to basically get the inputs how much would be the consideration B would have paid if he wants to maintain the same percentage which he is getting now. Now, that's the reason I said that step number 2 becomes very crucial indeed. Post business combination, A is getting a 40% stake in the combined entity, but indirectly we can say that B is getting a 60% stake. And this 60% figure is required if you want to calculate a purchase consideration. And therefore, as I said, I insist that even if the examiner is giving you that it is a reverse acquisition, without this 40-60 percentage, my calculations of PC cannot be done. So in this case, we can say that B is getting a 60% stake in the combined entity. So when I say the same percentage, let me make a mention. It is a reference to 60%. So let's see how many shares would be given to the shareholders of A if he wants that same percentage. Now, B in his own company is got 60 shares. Let's assume that if he were given X number of shares to the shareholders of A, his total share capital would have been 60 plus X. So we can say B gets 60 shares in his own company. Had he issued X number of shares, this would have been the total capital of the company. So he would issue X number of shares in such a way that he gets a 60% stake in his company. So we can say right now there are 60 shares. If he would have issued X number of shares to the shareholders of A, this would have been the total share capital and issued in such a way that he maintains a 60% stake. Now, if you calculate the value of X, I think it works out at 40. It works out at 40. So A would have issued to B would have issued to the shareholders of A 40 shares. So my purchase consideration is equal to 40 shares of B into the fair value of shares of B. So B would have issued 40 shares in his company, and let's consider the fair value B. So we're given the fair value B is 40. So 40 into 40, the purchase consideration is 1600. So now you can clearly see that the focus point is not in terms of what is given, but the focus point is in terms of what would have been given. But there is one more interesting input. If you've seen the regular sessions, you would have witnessed I've done a complete, analysis in terms of 4 permutation combinations. I'll not get into that kind of mode of giving you 4 permutation combinations, but once you're done with this calculation, you need to revisit on one very important issue. That if the purchase consideration is only in equity shares, Index 103 says that if your purchase consideration is only in equity shares, consideration is not what would have been issued, but what would have been acquired. So the purchase consideration is the fair value of what is acquired. So in this case, since purchase consideration is only in shares, since purchase consideration in only in shares, PC is equal to fair value of what is acquired. PC is the fair value of what is acquired. That is more reliable in nature. That is more reliable in nature. So this calculation needs to be done only when the purchase consideration is only in shares. Then we can say the PC is not what would have been given. The PC is that after giving that, what do you get? So we can say B, by issuing the shares to the shareholders of A, would have got a control over the company of A. So the company A has got a total of 100 shares. So B, if he would have issued 40 shares to the shareholders of A, he gets a control over the company of A. So we can say what he gets in return is 100 shares of A. He gets a control over 100 shares of A into the fair value of the shares of A, which is given 16. So this also works out at 1600 only. But that is not a chance. The fair value of what would have been given is 1600. The fair value of what is acquired is 1600 for the reason The fair value is 40, the fair value is 16, 40 by 16 is 2.5. The exchange ratio is based on the fair value of the share. So whether you consider the fair value of what should have been given or you consider the fair value of what is acquired, the answer is the same. But I would say you should still show both the calculations to the examiner. Give him the clarity of thought that you know that the purchase consideration is only in shares. What is more reliable in nature is the fair value of what is acquired rather than what is issued. Simple. So that is the step number 4. Let's go to the next input. That is step number 5. The step number 5 is on the calculation of the NCI, and there is no NCI in this case because we acquired all these shares in this case, so there is no NCI. And then we go to the step number 6, and that is the calculation of the goodwill or the bargain purchase gain, as the case may be. So this is simply the purchase consideration. There is no NCI, but I'm just going with the format. And we consider the net assets. So we'll get the goodwill or the bargain purchase gain. The PC is 1600. NCI is 0. I guess the net assets was 1300. Let me just verify. Yes, PC is 1600 and this is 1300. So we get a goodwill to the extent of 300. And in terms of reverse acquisition, there's no need of putting any entries because this is going to be done in the books of the accounting acquirer. So we can directly now make the balance sheet. Now there are some interesting inputs with reference to the balance sheet as well. Because when you will make a balance sheet in terms of reverse acquisition, there are 2-3 pertinent points. The number of shares to be taken in the balance sheet, and when you're going to consider the assets and liabilities of A and B, whether you consider the book value, the fair value of which company, that's the pertinent issue. So the question is focusing on the consolidated balance sheet. So I think I'll do one thing. This time in reverse acquisition, slight change in the formatting of the balance sheet. We'll take A, we'll take B, and we'll get the consolidation. So this is A, this is B, this is the consolidated balance sheet. So we're making the consolidated balance sheet of A company. The balance sheet is going to be presented by the legal acquirer because he has got the legal obligation to present the console. So the heading is the consolidated balance sheet of A. And let's consider the balance sheet assets right to begin with. So let's take this as asset. Now, the crucial inputs. As far as A is concerned, he is the accounting acquiree. So you need to pick the fair values of A. And B is supposed to be the accounting acquirer. So we're going to take the book value. So one focus point when you make a consolidated balance sheet in a reverse acquisition, accounting acquirer, book value, accounting acquiree, we need to consider fair value. So let's begin with the asset side. So we have non-current assets. As far as A is concerned, we consider fair value. And B, we consider the book value. And that is 3,000. So that works out at 4,500. Then I think least we forget, let's take goodwill. That is 300. And let's take the current assets. The current assets is 300 and no, it's 500 and 700. So that works out at 1,200. So I think this is all on the asset side. Let's take the sum total of this. That comes to, I think, 6,000 on the asset side. Now let's focus on the equity and liabilities. Now, when you consider the equity and liability, the first focus point is to get the information regarding the equity share capital. Since we are presenting the balance sheet from the point of view of the legal acquirer, the number of shares to be represented is from the legal acquirer's perspective. A is got 100 shares and he's issued a total of another 150 shares to B. So the number to be reflected is from the legal acquirer's perspective. So let's consider the equity share capital. So this is going to be 250 shares. This is going to be 250 shares in this case. But when we are going to consider the balance sheet, so we will consider the share capital in this particular case. B is got a share capital of 600. The figures out here is from B's perspective. His share capital is 600 and the purchase consideration 1600. The value is based on the accounting acquirer. The number is based on the legal acquirer. So I think let me put this as a focus point. This is from the point of view of the legal acquirer. This is for the point of view of the legal acquirer, and the value is from the point of view of the accounting acquirer. So that is another crucial point to be considered. The value based on accounting, the number based on legal. So I think that works out at 2200. And then we consider the retained earnings in the balance sheet of B, and that is the other equity. So let's put it as RE, and that's to the tune of 1400. And there's no NCI, then we consider the non-current liabilities as well as the current liability. The non-current liabilities are to the tune of, I guess, 400, 1100. So that makes it a total of 1500. And we're also given the current liabilities is 300 and 600. So that makes it a total of 900. So let's see whether the balance sheet is agreed, tallied on this. So 2200, 1400, and 2800. Yes, the balance sheet total is supposed to be 6000. Well, so I think two comprehensive questions. One is on the case of acquisition accounting. One is the case of reverse acquisition. The only filter which you need to keep in mind on a reverse acquisition is the concept of the purchase consideration. Rest is all quite simple and straight. Okay, now let's go on to the next area of discussion, which is on the concept of a common control. But first, I think let me make a little quick mind map in terms of a common control, though we had a discussion on that initially. So let's make another mind map in terms of a common control transaction. So let me, I think, call this as a mind map number 2, because all that mind maps which I made earlier was a part of the trail of the 7 steps on acquisition accounting. So that's like my mind map number 2 for the day. So I'm focusing in terms of common control transactions. We are focusing in terms of common control transactions. I think just to draw your inputs once again, we had a discussion when we triggered off the concept of business combination that common control generally happens when it is a case of related party transactions and the parameters are met. The parameters are basically two. Before and after the business combination, the entities are under the control of the same entity. And the parameter number 2 is that the control is not transitory. We need to ensure that there is no manipulation, and therefore we need to consider that this control, the common control, was not artificially created, but it was something which was always there. It's not that, on a temporary basis, to bring the entities under the common umbrella, you first did a transaction to bring it under the control, and then a second transaction occurred. So the focus point in terms of this is, when you consider common control, it is when it is between related parties and we are able to meet some conditions, and there are 2 set of conditions. The first set of conditions is before and after, business combination, the entities are under CC. I'm putting it as common control. The entities are under the common control of the same entity. So the entities which entered into transaction, they were under the control of the same entity before. They are under the control of the same entity, or we can say common control, because there could be more than one investors as well. So that's one parameter. And the second parameter is that it is not transitory. This is not something which is being planned as we decided in the regular session. So it is not transitory in nature. Now, once you establish that it's a common control transaction, the accounting is pretty simple, unlike what you do in terms of acquisition or reverse acquisition accounting. I think the focus is in terms of the entries to be put in the books of the acquirer as well as the acquiree in terms of the common control. So you can say generally, I'm saying generally, the common control transactions, one of the most common examples is a case of a demerger. So I think I'm going to focus the entries, because when you say common control, I think the most common example which occurs in this particular case is the case of a demerger. So we'll look at the entries from that perspective. So the most common example is the case of a demerger. So we'll look at the entries in terms of a common control transactions from a demerger perspective. I remember the question of Maxi Mini, and you create a new company, Mini, to take over the mini divisions of Maxi Mini. So I think we'll just focus on that as a mind map. So let me just create entries out here. So let's consider the same example. So let's say this is the company Maxi Mini, and this is the company which is Mini. We can call this as the resultant company for understanding, and this is what we can say is the existing company. So the company Maxi Mini has got two divisions, Maxi and Mini. Mini is being taken over by the company Mini Limited. So this is more like, acquirer, and this is more like the acquiree, but I'm calling it as a resultant company and calling it as an existing company. Now, if we first focus on the entries of the resultant company, in terms of the resultant company, what will he do? He will capture the assets and he will capture the liabilities, and these assets and liabilities will be captured at book value. Because in terms of a common control transaction, the focus is very clear that we are considering the acquisitions at what we call a pooling of interest method, that is a book value accounting. So all the assets and liabilities of Maxi Mini division becomes the assets and liabilities of Mini Limited, and that is all at a book value. And we also need to consider one complete little thing out here. In terms of common control transactions, no assets and liabilities which are not in the balance sheet of the existing company can appear in this entry. So no new. We can say no new assets and liabilities can be incorporated in this entry. So since it's based on a pooling of interest, your focus needs to be clear that all the assets and liabilities captured at book value, and all these assets and liabilities, only those which are in the balance sheet of the existing company, appears out here. One. Second focus. The second focus is when you consider the purchase consideration. As a part of the purchase consideration, we will generally give cash, and if we give the shares, you are not going to consider the fair value. The shares will be taken at face value. The shares will be taken at a face value. Let me make it clear, not at a fair value. So I think let's put it as fair value, because FV face value fair value looks the same. So not at a fair value. So when you consider the purchase consideration, you take the sum total of the cash and you take the sum total of the shares, but you take the shares issued at a face value plus the cash, that becomes the PC. Now, another focus point, when you put this particular entry, any balancing figure in this entry is never supposed to be a case of goodwill. The balancing figure in this case is going to be taken as other equity. It's like a gain or loss arising on a demerger. Because in this particular case, it's a book value approach, it's a pooling of interest. So all the element is other equity. It can be indirectly called as a gain or loss on demerger. It can be called as a gain or loss in terms of demerger. So this is the insights which you need to keep in mind as far as a company which is the resultant company, assets liabilities at a book value with no new assets liability, PEC at a face value, not a fair value, and no goodwill arises on the acquisition. Now, looking at the entries in the books of Maximini, the objective is to close. The objective is to close the assets and liabilities which are transferred. The objective is to close the assets and liabilities which are transferred. So he will simply debit the liabilities and he will simply credit the assets, and this will all be done again at a book value itself. Now, there's another input which you need to keep in mind, that in terms of common control transactions, especially the concept of demerger, the consideration is never given to the company. So as far as Mini Limited is concerned, he will be passing on that consideration to the shareholders of Maximini and not to Maximini. So Maximini will never receive any consideration. The shareholders will receive the consideration. So he's got nothing to show in terms of getting anything. Simply any balancing figure in this entry is again going to be taken as a part of the other equity. So this is going to be taken as a part of the other equity, just like that. So this is also nothing but we can say a gain or loss on demerger. This is like a gain or loss on demerger. So the accounting for a common control transaction actually becomes quite easy in nature. That is the theoretical insight. So no steps involved, simply looking at the entries. So you just need to remember no goodwill, and the entire accounting is book value. He closes on a book value, he captures on a book value, shares are taken at face value, differences on both the sides are taken in terms of other equity. No goodwill arises in the books of either of these companies. Right, so I think this is on the aspect of a common control transactions. So I think we'll pick up a question which is on the Maximini itself on this area. But I think before we take this further, I think let's first give you a break, and then I think we can start our inputs on the common control transactions. So let's relax our minds before we do a question on this area. Thank you. relaxation of mind. And I think now it's time to do a question on common control transactions before we close in this 103 with you. So let me share a question with you on 103, the same Maximini question, I think what we've been discussing. So question number 6, I am given the inputs. It says Maximini has got two divisions. One is Maxi and one is Mini. And the draft information about the assets and liabilities on October X2 is given. Then it says in the additional information, it is being decided to form a new company, Mini. It says to take over the assets and liabilities of Mini division. Accordingly, Mini is incorporated. And then it says you are asked to pass journal entry in relation to the above in the books of Maximini as well as Mini. Show the balance sheet of the two company as on the morning of 1st November X2, showing the corresponding previous year figure. Now, there is nothing too sentimental about the fact that we are required to make a balance sheet on the morning of 1st November. That is, just a next day after the balance sheet date. Then he says the directors of the two company ask you to find out a net asset value of equity share pre and post demerger. And then it says comment on the impact on the demerger's shareholders' wealth. Now, I think before we proceed with the question, I think it's important to first of all, prove the point that whether it is a case of common control or not. Now, since it is a case of a demerger, you would rightfully agree with one particular point. The shareholders of Maximini are getting the shares in terms of Mini. So you can say the shareholders of the company had a control over Maximini, and the shareholders also have a control in terms of Mini. Now you would say, sir, in this particular case, when you're saying that the shareholders had a control over Maximini and they also have a control over Mini, but these shareholders could be quite scattered indeed. So yes, in a way, I am taking a presumption that there might be a particular shareholder of Maximini who was having a control over the company. Though we're in this status, we are given this fact. So indirectly, yes, it's a presumption that there might be, one or maybe a group of certain shareholders who had a control over Maximini. Now, once they get the shares in Mini as well, they get a control over Mini as well. So we can say the same set of people, the same set of shareholders had a control over Maximini pre-business combination, and they've got a control over Maximini and Mini post-business combination. So that brings the transaction under the purview of common control. So if you want, you can give that note also to the examiner that you are indirectly taking a presumption that one shareholder or maybe a group of certain shareholders, because once it is a group of shareholders, they also need to have unanimous consent, because they must unanimously agree that they are going to exercise a joint control. Then it becomes under the case of common control. So on that presumption, let's, I think, begin the inputs. So this is question number 6. Let's solve this question number 6. This is on common control. So I'm just putting the inputs. You can keep giving a note as well, but I'm just putting that I'm solving it as a common control transaction. Now, the focus is in terms of entries in the books of Mini, which is the resultant company, and in terms of existing company, that is Maximini. So I think I'll do one thing. I'll take a little comparative position. Let me just open the question first in front of me. Right. So first of all, we can just make a comparative entries in both the set of books. Let's first focus in the books of mini. Let's first do the entries in the books of the resultant company, that is the books of mini. And then we just need to make a closure of the assets and liabilities in the books of max mini. So I'm just going to pick up the information looking at mini division because it very clearly says a new company mini was incorporated to take over the assets and liabilities of mini division. So if I look at the data in terms of mini division, so we have got the assets, let's call it as a PPE. So the PPE is going to be captured at a book value. The book value of mini is 200. And then we've got the current assets. The current assets are 300. And then we've got the current liabilities. The current liabilities are to the extent of 100. And there is a loan that also gets a credit to the extent of 100. So I think all the assets and liabilities are done. Oh, is that question a too dangerous one that it got the disconnect? So we have taken the assets, current, non-current, and liabilities, and the loan funds. And now we need to consider the purchase consideration, which is payable to the members of Maximini. So I'm putting it as members of Maximini because the consideration is given to the shareholders of Maximini. And very clearly says that we are going to give them 5 crore shares of 10 each. So we need to consider the face value. So that comes to 50 crores. And we can see the balancing figure in this entry that can be taken to other equity. So there is a balancing figure 250 on the credit side. That's going to be other equity. Call it as a capitalism, but basically it is, again, it's a part of the other equity. So this is one entry. Let me also discharge the PC and put the entry here. Members of Maximini gets a debit and the equity share capital gets a credit. And this is to the extent of 50 crores. All the shares are issued at a face value sum. Okay, so this looks at the entries in the books of Mini. Now let's see the books of Maximini. Maximini has got the objective of closing the assets and liability. So we can simply debit the current liabilities, debit the loans, and we can credit the current assets. And I think we can do one more thing. As far as PPE is concerned, give a separate closure to the accumulated depreciation and a separate credit to PPE. So, what I've done, I've taken a closure of the accumulated depreciation and closure to the PPE separately and the current assets. So this can be copied from here. This is 100. This is 100. The current assets is supposed to be 300. And we can take the separate values of the gross block and the accumulated depreciation. This is 100 and this is 300. Now, Maximini cannot reflect that there is anything which is receivable from Mini because he is not getting any consideration. It is the shareholders getting the consideration. So let's see the balancing figure. The balancing figure in this entry is coming on the debit side. That is 300. This can be taken as other equity. This is nothing but we can say is a loss on demerger, which can be adjusted against the other equity in the balance sheet of the company. So this answers one requirement of the question, that is the entries in the books. Then he's also asking us to make the balance sheets pre and post demerger. On that basis, we need to get the intrinsic value, you call it as a net asset value or the intrinsic value. And then on that basis, we need to prove the shareholders' wealth impact as well. So let's make the balance sheets now. So we will make some comparative balance sheets of the company. So one balance sheet for Maximini, which is going to be pre and post demerger. and one balance sheet of mini. So this is maxi mini. This is pre-demerger. This is post-demerger. And this is mini. Mini was not there pre-demerger. So this is post-demerger only. So let's make the balance sheet of both the companies pre and post demerger as instructed. Now, as far as the pre-demerger balance sheet is concerned, that can be copied as it is from the question, and then we can just incorporate the entries which we have done, and based on that we can just get the post-acquisition things. So let me just first copy the balance sheet from the existing one. I guess first of all, we've got the property, plant, equipment, and I'm just copying the figures of Maximini. It's 300. Then I am given the current assets that is appearing to the extent of 700. So this is on the asset side. This is on the asset side of the balance sheet. Just copied it as it is. Similarly, we can get the status on the liability side. So on the liability side, we have given the equity share capital is 50. That's pre-demerger. Then there is other equity, and that is 650. Then there is a loan, that is 100, and there is a current liability, and the current liabilities is given to the extent of 200. So this is coming to a total of 1000, and this is also 1000. So this balance sheet we have copied as it is from the question. This is the position of Maximini, which is given in the question pre-demerger. Now, very simple. Just look at the entries which you've done in the previous part for Maximini as well as for Mini. Maximini is basically closing certain assets. So the PPE is down by 200. So this becomes 100. This becomes 200. The current assets is down by 300. So this remains at 400, and this is 300. Then we come to the share capital. This is 50, and he is also issued to the members of Maximity 50. Now the other equity is down by 300, so this becomes 350, and he got other equity 250. The loan is gone, it shifts here, and the current liability is down by 100, so this is 100 and this is 100. So basically the balance sheet is getting a split. So this is 500 and this is 500 and this is 500 and this is also 500. The balance sheet of the company pre and post demerger is done. That's simple and straight indeed. That answers only one requirement to the question, that is the balance sheets and the journal entry in the books of Maximini and in the books of Mini. Now the focus is to get the net asset value per share and explain the shareholders' impact, wealth on the impact. So let's do one thing. Let's now make the calculations. So we can again consider the calculations for the intrinsic value, Maximini as well as Mini, and we can get this pre and post demerger. So pre and post demerger, the idea is to calculate the intrinsic value or the net asset value per share. So get the net assets, divide this by the number of shares, and we get the net asset value. We get the net asset value per share. We get the net asset value per share. You can even call this as intrinsic value per share. The net asset value per share or the intrinsic value per share connotes one and the same thing. Now, since there is no concept of a fair value and I am nowhere given anything, but I would like to caution one thing. When you calculate the intrinsic value of the share, you need to consider the assets at a fair value. Now, in this particular example, we are not given any fair values, so indirectly the book values are being considered as good as fair value. Otherwise, the balance sheet will get drafted on the basis of book value, but the intrinsic value is going to be based on the market value. But in this case, we are not given any information, so we can comfortably consider the book values itself. So there are two approaches of calculating the net assets. Either you take assets minus liability, or you simply take the equity share capital plus the other equity that is as good as net assets. Because if you take assets minus liability, it is nothing but the share capital plus the other equity. So 700, 400, this is 700, sorry, not out here. This is 700, this is 400, and this is 300. So when you take the net assets, either you take assets minus liability, or alternatively you take the equity share capital plus other equity, turns out to be the same. The number of shares is to the extent of 5 crores. So this comes to 140, this comes to 80, and this comes to 60. So this answers another input that this is the intrinsic or the net asset value per share of the company. Now the question is focusing on the shareholders' wealth. So if you're looking at the impact on shareholders' wealth, we're looking at the impact on the shareholders' wealth. So here again, we need to compare the position pre and post demerger. So we need to compare this pre and post demerger. What is the impact on the shareholders' wealth? Now it is simple. The shareholders of Maxim Mini had one share in the company. And when Mini was formed, they were given equal number of shares, and that means they've got one share for every one share in the new company. Because we have given them a total of 5 crore shares. The existing shares in the balance sheet is also 5 crore. So they got one share for every one share. So earlier, the shareholder had one share in Maxim Mini. So we can say he had one share in this company, which was worth 140. Now, post the demerger, he gets one share in the new company, Mini, as well. So now he's got a share in Maxim Mini, and he's also got a share in Mini. So he's got one share in Maxim Mini, which is now worth 80, and he's got one share. And he's got one share in Mini, which is worth 60. So if you take the sum total of this, it comes to 140. So earlier he had one share in Maxim Mini. Now he's got one share in Maxim Mini and one share in Mini. The total wealth still remains intact. That is at 140, and there is no impact on the wealth. There is no impact on the wealth of the shareholder. Now let's do a little more discussions on this particular point. Is it because that they've been given one share for every one share? Is that the reason that there is no wealth impact? Of course not. Even if the ratio of exchange was not 1:1, but let's say it was 1:2, or let's say it was 2:1, this will still turn out to be the same. The reason of this is that since everything is done at a book value approach, in this particular case is just a wealth split. And if it is a wealth split, in this particular case, the wealth earlier and the wealth post the split cannot undergo a change. You can even try this out, that if you say that the share exchange ratio was 2:1 or 1:2, remember that would change the intrinsic value as well. Because if the number of shares would change, then the intrinsic value will also change accordingly. So try this out on a mathematical level. The exchange ratio has got nothing to do with the wealth impact. It is only the book value approach which has resulted in dividing the wealth in such a way that you get one share in the existing, one share in the new company, at book values, the total wealth would remain the same. So I think this takes care of our inputs in terms of Ind AS 103. Now we are sorted in terms of all three kinds of accounting: acquisition accounting, reverse acquisition accounting, and the common control transactions. But let me also, remind you, because everything, of course, cannot be done in the revision. But I think let me also remind you that especially when you're looking at a reverse acquisition and a common control transactions in the study material, you'll see a beautiful illustration which illustrates the concept of new company created. I'm referring to the question which has come in the exams as well. AXBX becomes ABX. So in that particular question, the question is done with the reverse acquisition and it is also done with the common control. So what I have done so far are questions which are, new company was not created. In terms of reverse acquisition, new company was not created. And there is a question AXBX where a new company gets created, so it slightly gets different. Let me see if that question I have put in the Super 20 questions, then maybe we can just have a visit on that question, I guess. Oh, yes, I put that question. So I think it makes sense. Let's do one more question on this area. Let's give Ind AS 103 a good closure on that. So I am sharing another question to you on the screen before we close this. So question number 9, and this is MTP October 2018. A similar question has already come in the exams as well. So I think let's do the question number 9. So let me read the facts. Question number 9. It says AX and BX amalgamated on and from 1st January. It says on 1st January X2, a new company, it says ABX, and with shares of 10 each is formed to take over the business of the existing company. So we are given the balance sheet of AX as well as BX, and then it adds on in the additional information. It says ABX issued requisite number of shares to discharge the claims of the equity shareholders of the transferor company. Also, the new debentures were issued in exchange of the old series about the company. We need to prepare a note showing the purchase consideration and the discharge and draft the balance sheet of ABX. Number 1, assuming that the entities are under the common control. Now, this is a case where a new company, ABX, is created and both the companies come under the common control. I think that part is easy because all you need to do is just add up the two balance sheets, and trust me, that is the answer. And then it says, assuming BX is a larger entity and their management will take a control of the entity ABX. So when he gives you that information, the BX is a larger entity, it is indirectly telling you that he is the accounting acquirer, though the legal acquirer is ABX, but BX being a larger entity is supposed to be the accounting acquirer and will take a control of ABX. And the fair value of AX as well as BX is defined. So this is, one question where we are given the inputs of creating a new company altogether in terms of reverse acquisition. So I think let me solve this out to you. So we're concentrating on the reverse acquisition. Common control, I said, just add the two balance sheets and end of the game. So I think my focus is on the case of reverse acquisition. The focus is on the reverse acquisition. So as usual, we're going to start with all these 6 steps, not the 7th one. So we're going to concentrate on the 6 steps on this. So let's begin with step number 1. So first we need to get the date of acquisition. The first thing we need to get is the date of acquisition. So in terms of the date of acquisition, I am given very clearly a new company is created on 1st January X2. Then we go to the step number 2. And here we need to get the accounting acquirer. Now, as I made a mention earlier as well, and I think I'd like to emphasize this point again, and that is, even though it is very clearly stated in the question that BX is a larger entity, we know that BX is the accounting acquirer, but we need to do this step because we need the percentages, which is going to help me in the calculation of the purchase consideration. So getting the status of the percentage which BX gets in ABX is going to be an important input. So I think let's do the calculations on this. So we can consider the status of pre and post business combination. So let's first of all consider the shares in ABX. Now we are given as far as AX and BX is concerned. Rather, let's not make this pre and post. Okay. Let's, I think, do a different calculations out here. So in this case, let's take the shares of AX and BX to begin with. If you look at the balance sheet of AX and BX, I am given that AX has got 600 shares, 10 rupees each, and BX has got 700 shares. Now, very clearly, we are given, it says ABX will issue requisite shares to discharge the claims of the equity shareholders of the company. Now, shares, these are the existing shares. They will not be given these shares. They will not be given these shares. They will be given the shares on the basis of fair value of the business. So if I consider the fair value of the business, so I am given the fair value of the business of AX and BX. That's given in the box below. The fair value of AX is 11,000 and the fair value of BX is 14,000. Now, once you get the fair value 11 and 14, you need to divide this by 10 rupees, which is the issue price. Now, you would say, so how is the issue price going to be 10? ABX is a new company, and since ABX is a new company, you would land up issuing the shares at a face value. So that is again, a simple logical presumption that the shares will be issued at a face value of 10. Generally, the face value is 10 because AXBX has got a face value 10. So the number of shares to be issued, is going to be 1100, and this is going to be 1400. So if we add this, that works out at 2500. Okay, now the calculation which is important is to see that out of the total 2500 shares of ABX, shareholders of AX get 1100 shares and shareholders of BX get 1400 shares. So what is the percentage stake each gets? So let's do the calculations. So we can say AX as well as BX. AX gets 1100 shares out of 2500. So he's getting 1100 out of 2500. And B shareholders get 1400 shares out of 2500. So if we calculate the percentages, undoubtedly BX gets a larger percentage. So 1100 by 2500, this comes to 44%, and this comes to 56%. And we need this 56 percentage as well. To calculate the percentage, we'll have to calculate if BX would have issued the shares to AX, then to maintain a 56% stake, how many shares would have been issued? So I think this 56% is going to be required at that stage. Okay, so the step number 2 is done. So this also proves that he is the accounting acquirer. Since a new company is created, undoubtedly, it is a case of reverse acquisition, because we made it very clear that if a new company created and the consideration is in shares, undoubtedly it is always a reverse acquisition. One of the existing companies will definitely become the accounting acquirer. Okay, now with this, let's go to the step number 3. Now there is no deferred tax inputs which are given in the question. So the question of step number 3A does not arise. No deferred tax implications. Directly go to the list of net assets. So we'll make the list of net assets. We'll make the list of net assets. So in terms of the list of net assets, now again remember the focus point is very clear, and the focus point is we need the figures of the accounting equity, and in this particular case the accounting equity is supposed to be AX, because when it is reverse acquisition your mind needs to be very clear on the agenda that we need, in this case the list of net assets of the accounting equity. So let's pick up the information of AX wherever the fair values are given, scrutinize the balance sheet, pick up the fair values wherever relevant. So we're given a PPE, I am given the fair value, and that's to the extent of 9,500 in the addition information. Then there is investments. Investments will take the value 1050 as it is. No fair values are given. So investment. And then there is inventory. Inventory is got a fair value 1300. Inventory is taken at a fair value. And then there is trade receivable. The trade receivable is 4,000. And sorry, not 4,000, sorry, 1,800. So for AX, it is 1,800. And then we are given the cash in, cash equivalence is 450. That's it on the assets. Then on the liabilities, we have the debentures, that's 3,000. Minus the debentures, that is to the tune of 3,000. So we're giving them same debentures, new debentures with the same series, and trades payable is 1,000. And that's it. Nothing else is given in the additional information for any other item. So I think that gives me the list of the net assets. So 9,500. That works out, I think, at 10,100 is the net assets. Now comes the crucial step in terms of calculating PC, step number 4. So let's go to the step number 4. So step number 4, we are calculating the purchase consideration. We're calculating the purchase consideration. Now, in terms of calculating the purchase consideration, you again need to remember the focus points which I gave you. Acquisition accounting, the focus is what is paid, and reverse acquisition is what should have been paid. And also, if the consideration is in shares only, we need to consider that what is the fair value of what is acquired. And in this case, also the consideration is only in shares. So we're going to do both the calculations in this case. So let's split this in two parts. Let's consider what is the fair value, what would have been issued, and then let's consider what is the fair value of what has been acquired. What has been acquired. So this becomes more reliable in nature. So since it is only in equity shares, you should show both the calculations to the examiner, that what is the fair value which would have been issued, and also consider the fair value of what would have been acquired. So once you give it, what do you get in return? So let's first consider that if BX wanted to maintain If BX wanted to maintain, I think we got 56%. Yes. So if BX wanted to maintain a 56% stake, now let's see how many shares would have been issued in this case. So we want to consider if BX wanted to maintain a 56%, what would have been issued by BX? So if we go back to the balance sheet of BX has got the number of shares in the balance sheet is 700. So let's say if it lands up issuing X number of shares in such a way that this comes to 56%, let's solve this value of X. So the shareholders of BX have got 700 shares. If they issue X number of shares to the shareholders of AX in order to maintain a 56% stake, let's see what is the status. I think the value of X comes to 550. So the value of X comes to 550, and that gives me a 56% stake. So we can calculate the purchase consideration. So 550 shares would have been issued. And I think now we also need to get the fair value per share. And in this particular case, the fair value per share is not directly given in the question. I am given the fair value of the business with which we can organize the fair values of the share. So let's make a small working note here itself. So we want the inputs in terms of two companies, AX and BX. Let's calculate for BX, AX both. So we are given the fair value of the business is 11 and 14. The fair value of the business is 11,000 and this is 14,000. And if you divide this by number of shares, it's appearing in the balance sheet at 600 and 700. So we can get the fair value per share. Unlike that question which we did today earlier on reverse acquisition, the fair value of the shares of the two companies was defined. In this case, he gave you the fair value of the businesses. You can divide it by number of shares to get the fair value per share. This is 20. And this is going to be 18.33. Right, so I think this gives me the fair value of the shares of BX. So BX is going to issue 550 shares to the shareholders of AX at the rate of 20 per share. That works out at 11,000. By the way, this 11,000 works out equal to the fair value of the business. Is that a chance? Of course not. Because in this particular case, again, if you're making a payment based on the fair value of the business, the purchase consideration has to be equal to 11,000 only. It is only, trying to calculate the discharge of the purchase consideration, that out of that 11,000, how many shares are issued at what price. PEC is already known in advance, because if I know that AX is the accounting acquiree, this 11,000 is the purchase consideration. But the idea of calculating the fair value of the shares is to get the discharge of the purchase consideration as well. Okay, now let's do the alternative calculations. Since in this particular case, we can say the company has issued only shares as a part of the purchase consideration. So we need to compute that if BX issues 550 shares to the shareholders of AX, he gets a control over the entire shares of AX. So what does he get? He gets a control over 600 shares of AX. By issuing the shares to the shareholders of AX, BX will get a control over 600 shares of AX, and into the fair value per share, that is of course of AX, and this is also going to be 11,000. Now you would say, what is the need of calculating both these things if you're going to get the same answer? At least you're going to tell the examiner that in terms of the provisions of Ind AS 103, if the consideration is mainly, I would say only, not mainly, is only in shares, What is more reliable in nature is the fair value of what is acquired and not the fair value of what is issued. You can refer to the regular sessions where I have made a complete comparative of four permutations combination. If it is acquisition accounting, calculating the fair value of what is issued, calculating the fair value of what is acquired. If it is reverse acquisition, calculating the fair value of what would have been issued and calculating the fair value of what is acquired. So in terms of acquisition accounting, this principle would apply. In terms of reverse acquisition also, this principle will equally apply. Okay, so once the purchase consideration done, then we come to the step number 5, which is NCI. And the best part, I've seen that in all the questions on reverse acquisitions, there is no NCI. So we don't land up calculating NCI. We always get complete control in these cases generally. So now let's look at the step number 6, which is on the calculation of goodwill or the bargain purchase gain. But we'll keep the format simple. We'll keep the same formatting for calculations. We take the PC, add the NCI, and compare this with the net assets. And we're going to get the goodwill in this case. The purchase consideration is 11,000. There is no NCI, and net assets was 10,100. So there is a goodwill to the extent of 900. Okay, so I think the 6 steps are done, entry not required. But now we are also going to make the balance sheet of ABX, because the legal requirement to present a consolidated balance sheet lies on the legal acquirer. So let's make a balance sheet as well. So rather, let's call it as a consolidated balance sheet of ABX. Now, in order to draft the balance sheet here again, your mind needs to be very clear that we are preparing the balance sheet in the name of ABX, but at the background, we are considering that BX is acquirer, accounting acquirer, and AX is the accounting acquiree. So in the balance sheet, when you consider the figures of BX, you consider book value. When you consider AX, you're going to consider fair value. So I think let's make a balance sheet, because that sometimes gets tricky. So we'll make columns in terms of AX, BX, and consolidated balance sheet. So we'll take AX, we'll take BX. BX will consider book value. AX will consider fair value, because he is the accounting acquirer. He is the accounting acquirer. So let's begin with the balance sheet. So starting with the asset side, we've got non-current assets. So we've got the non-current assets begins with PPE. So wherever fair value is there, we'll pick that up. So PPE for AX is supposed to be, the fair value for AX is given, it's 9,500. BX, we consider the book value, that is 7,500. That makes it 17,000. Next, I think least we forget, we are given the goodwill. I guess let me fit the goodwill, that's 900, just compute. Then I guess we are given the investments, book values only, that's 1050, and I think that is 550. That works out, I guess, at 1600. That's it on the non-current assets. Now let's take the current assets. So inventory, we had a fair value, that's 1300. Inventory is at a fair value, that's 1300. And this is 2750. That works out at 4050. Then there is a trade receivable, and that is book value is only 1800 and 4000. That makes it 5800. And then cash and cash equivalents, and that is to the extent of 450 and 400. So that makes it a total of 850. So this will give me the total of the balance sheet. 1725. I think this is coming to a total of 30,200 on the asset side of the balance sheet. Well, so this is done. Now let's go on to the liability side of the balance sheet as well. Same formatting continues. I am intentionally making the balance sheets also doing the question at end to end, because sometimes we fail to get the grip in terms of making a balance sheet. So I think I'm just trying to keep it end to end so that you are able to get the entire inputs. So this is the equity and liabilities, AX as well as BX, and the consolidated balance sheet. Now, as far as the equity share capital is concerned, this is going to be the sum total of the equity share capital is going to be the sum total of, we will take BX. So I guess if I take BX, it is to the extent of 7,000, and the purchase consideration. Okay, now in this particular case, when you consider the PC, in this case, the shares were issued at 20. So I think there were 550 shares. So we need to consider the face value. Premium will take it separately. So that works out at 12,500. And then we are given the other equity. So we consider the other equity. So other equity also, we are given 2,700 is the other equity of BX, and 550 shares into 10 rupees face value, the premium. Because shares are issued at the rate of 20, so we got to consider 10 rupees face value, 10 rupees premium. That face value in the share capital, premium is a part of the other equity. So this works out at 8,200. Right, so this is equity done. Then I guess on the liabilities, that is non-current liabilities. So we are issuing them new debentures. And it says they will be given new debentures. So let's keep the same. We give them 12% new debentures. I'll put it in the bracket as new. So this is 3,000, 4,000. They're given new debentures in lieu of the existing debentures. And that's it. Then on the current liabilities, we've got just trade payable. So trades payable, that is to the extent of 1,000 and 1,500. I think that's it. Nothing else is given. So let's see whether the balance sheet is agreed out here. So 12,500, 8,200, 9,500. That works out at 30,200 is the total of the balance sheet. Wow. Right. So I think that is one particular question which I definitely want to do to give you the connect in terms of reverse acquisition with and without a new entity. Now you can see that we have done the questions in terms of acquisition accounting, reverse acquisition when a new company is not created, when a new company is created, and we've done the concept of common control, which is on a demerger. Now, I would also advise there is one more question which I've done in the regular sessions, but every question cannot be done. So that is a question in the study material which focuses mainly on a typical levels in terms of the step number 3B. Because a lot of exceptions are given in that particular question. I think I'm just going to show you that question, but I think you can try this as an exercise. So I've already put that question out here. It is question number 8 in the assignment. This is there in the study material as well. It's one of the wonderful questions because I think it concentrates very well in terms of step acquisitions, in terms of step number 3B. So this is one particular question because it also contains the concept of what is called a measurement period concept as well. Here, if you just go and revisit the requirements of the question, because I think doing this question is going to be taking a lot of time. I think I've done this question in the regular session, so you can maybe watch this particular part. So like, for example, it says in the point number B, it says, will the amount of NCI and the goodwill or the bargain purchase gain, which you've recognized in A, above change subsequent to 31st March. So here it also talks about the concept of measurement period as a part of the exercise. I did not talk about measurement period concept, but I think I'll just like to quickly, give you some insights, not documenting this, but just quickly giving you some insights. When you consider the case of Index 103, it is a case of provisional accounting. And when it is a case of provisional accounting, if there is anything which is there, within 1 year from the date of acquisition, not 1 year from the date of balance sheet, but from the date of acquisition, if there is anything which happens within 1 year, because when you put the acquisition accounting, the assets and liability list which you create is all supposed to be provisional in nature based on the information on that date. Now, if new information comes at a later stage, and there are changes in terms of asset and liability, so it works something like India's 10, that if there is a condition which was there on the date of acquisition and there is something which comes as evidence confirming those conditions on the acquisition date, it is supposed to be adjusted against goodwill capital reserve. And if it gets adjusted against the goodwill capital reserve, then correspondingly your figures of NCI would also undergo a change. So I think this is one particular question you should definitely look into. Okay, now let's take it further. Now, I'm just going to make a little background in terms of Index 110. 103 gets over. Now, the focus goes to 110, 111, as well as 28, the three crucial standards. So, let me just, I think, get some corrects, basic corrects on Index 110. So, we've got a little time. So, I think we'll just spend around a few 10 minutes or so in terms of giving you the theoretical aspect, a quick revision in terms of the control assessment part. So we can start with the practical inputs in the next session on this. So this is CFS, that is consolidated financial statements. So CFS, that is consolidated financial statements. If somebody were to tell me that, okay, in terms of the examination perspective, let's divide Index 110 in terms of various elements. I would say typically 3 parts. Not 3 because I always land up giving 3-step models or I talk in terms of 3 inputs, but it is actually can be divided in terms of 3 parts. One is with reference to the concept of control assessment. And one is the concept of consolidation procedures. How does the consolidation of a balance sheet or a consolidation of an income statement takes place? And the third area is what we call the changes in the ownership interest. There can be step acquisitions. There can be a case of a disposal of shares. The status of the company changes. It may become a case of a control. It may become a case of losing control, converting to associate, converting to passive investor, or there could be a complete disposal. So once you revise the concept of Index 110, you need to divide your entire things in 3 parts. Control assessment, the core component, the consolidation in terms of balance sheet P&L, and the changes in the ownership interest. So we want to talk now in terms of the control assessment. So let's, I think, quickly make some parameters on the concept of control assessment. Because I don't want to spend too much time on the concept of control assessment. So let's, I think, quickly connect some dots. Now, you would remember in terms of control assessment, we divided our discussions in terms of three steps again. The first is the concept of power. The investor should get a power over the investee. The second is the investor is exposed to variable return from his involvement with the investee. And the third is the linkage between the power and the return. So control is not supposed to be a rule-based assessment that it is based on a percentage, but it is based on a subjective assessment. So we made a three-step model here. So in terms of the control assessment, step number 1, step number 2, and step number 3. So when it came to the concept of the first one, that is power. And then the second one is exposure to variable returns. Exposure to variable returns. And the third is the linkage. The third is the linkage between power as well as return. The linkage between the power as well as the return. Now, let's try to recall the concepts as far as power and as far as exposure is concerned. Now, when it comes to power, you remember that I gave you 3 insights in terms of power. So when it comes to the concept of power, we said there are 3 elements in terms of power. One is, we said, ER, that is called the existing rights. ER, that is supposed to be called the existing rights. Now, these existing rights could be in the form of either, you can say, voting rights, or it could be the right to appoint or remove the KMP. Now, the voting rights would also include the potential rights as well. As an investor, if you've got convertibles in the investee, that is included. So existing rights would typically mean that there is voting rights, This is including the potential voting rights. And it could also be the right to appoint or remove the KMP. It's a right to appoint or remove the key management person of the company. So you need to see that as an investor, you've got some existing rights. That means you've got voting rights. That can be the actual voting rights stem out of equity shares, or there are potential voting rights. And there could be a right to appoint or remove the key management person of the company. Second, you look at the parameter in terms of power, and that is supposed to be called CA, that is called the current ability. Now, when you say the current ability means not as of today. As an investor, I need to consider that when there will be a meeting where decisions will be taken on relevant activities, will I be, as an investor, be able to exercise my influence at that stage? I would say the control at that stage. So the current ability does not mean as of now, but it is when need arises. And we did a little extensive discussions on this end, that when we're looking at the current ability could mean that you've got already majority voting rights, or you are a party to a forward contract where you will be acquiring majority voting rights, or you're a party to an option contract where you got an option to acquire majority voting rights. So depending upon that, even today, you do not have majority voting rights, but before the meeting of the company takes place, when the decisions on relevant activities will be taken, will you be in a position to exercise the power at that particular stage? So that is when the need arises, when the meetings will occur. The third, we said, was supposed to be RA, that is called relevant activities. I also gave you in the regular sessions the list of what is relevant activities, because as an investor, you should be in a position to exert power in terms of like sale and purchase of assets, deciding the business model of financial assets, deciding the selling price of the products at which they will be sold. So you are basically in charge, in control, in power to take decisions on the relevant activities of the business. So your existing rights should give you the ability when the need arises to take decisions on the relevant activities. Then you get a power. Then comes the second input, and that is in terms of the exposure to variable returns. Now, when you say that you've invested in terms of equity shares, or there could be investment in terms of convertible debentures, for example, which are supposed to be potential ordinary share. Now, when you're investing in terms of ordinary share, you are getting dividends. But as I made mention that this is, exposure to variable return. It is not entitlement. The word is not that you're entitled to variable returns. The word is that you're exposed to variable returns in this case. So when you say that you're exposed to variable returns, that means there is a risk. So even say you've got convertible debentures in the company, then also you're exposed to variable returns because you are facing a credit risk. Because if the other party, due to the credit risk, is not able to pay you interest, you're entitled to a fixed interest, but you're exposed definitely to variable return. So invariably, you can say this becomes a yes. In both the cases, you are definitely exposed. You are definitely exposed to a variable return. Here you're entitled and exposed to variable returns. Here you're entitled to a fixed return, but you're exposed to a variable returns in this case as well. And finally, we decided, if you say power is a yes, and if you say exposure is yes, the linkage is there, we get a control. If you say the power is a yes, but the exposure is a no, then the linkage is not there. So in terms of the linkage, you need to see step one, yes. You need to say step two, yes. The linkage gets developed. Any one of the two says a no, the linkage does not get present. So there are a few questions which comes on a control assessment as well, but I think I'm just trying to connect some basic dots on control assessment. You can revisit if you want to see more details on the regular sessions, how the control assessment takes place, because we've dealt with each and every elements of these in great details of that. But otherwise than that, our focus would be in terms of doing the larger practical questions with you. So what I'm going to do in the next session, I'm going to focus on my second block, and that is the concept of consolidation. So we will first make a quick revisions of the 7-step models, what we decided for the purpose of consolidation. Once those 7 steps are done, we'll just quickly, insert those adjustments. Rather, I'll make a 7-step model, inserting all the adjustments discussed, give you a flow. We'll start making some practice questions. So next class, of course, we'll be concentrating completely in terms of the practical illustrations on 110. So I think that takes care of one element of our consolidation, that is Ind AS 103. Now the focus will be on 110 on Wednesday in the next sessions with you. So I think that's all for the day from my side. So I'm looking forward to see you on Wednesday for another Power Pack session. Thank you very much, friends. Thank you. Bye-bye. Take care.
Done, sir.
Hi. Thank you.
Thank you, sir.
Same to you. Thank you.